Welcome back, D-Traders. We present you with a fresh overview of the year's trade. Turbulence in the equity market has reached unprecedented levels in recent days. Thursday was a painful day for investors, and the equity market digested the Fed's interest rate decision, assessed their latest statistical data, and collapsed. The pre-market also looked like a solid red zone, and today, however, turmoil on the charts may somewhat ease. First of all, let's talk about yesterday's worst performers. Thursday has become the worst day for the main stock indexes, at least since the beginning of the year. The Dow lost 3.3% or 1,120 points. The Nasdaq plunged by 5.2% for the first time since 2020, and the S&P 500 tumbled by 3.7% to 4,131 points. The broad market index is now off to its worst start to a year since 1939. Today, the S&P 500 is likely to trade in the range between 4,100 and 4,180 points. Thursday became a dreadful day for traders on Wall Street, especially for big tech companies. Meta's stock fell by about 6.8%. Amazon's nosedived by 7.6% and Alphabet's dropped by 4.7%. Likewise, e-commerce companies recorded losses. Etsy's stock plummeted by about 17% on disappointing first quarter results, and eBay sank 12%. What could cause such a reaction? Analysts believe it could be that the market had fully assessed the future prospects for economic growth. The looming recession, the loss of jobs and wages, as well as tighter financial conditions, would exert pressure on practically all financial markets. The Fed needs a weaker stock market and higher bond yields. Investors seem to have finally started to realize this. Naturally, next week's inflation report will be at the center of attention, but so far the market's reaction indicates it prepares for a more aggressive Fed. Yesterday, the US dollar index hit its yearly high of 104 points and then fell to the 103.5 level. Today, USDX is seen moving in the 103.30 and 103.80 range. The greenback is getting stronger, while the US Central Bank is trying to bring persistent inflation under control. In light of global developments, the dollar has considerable growth potential. Demand for the safe haven is on the rise, so we will unlikely see the index going down anytime soon. Today's strong labor market results provided additional support for the greenback. Non-farm payroll employment surged by 428,000 jobs in April, matching the revised jump seen in March. Meanwhile, economists had expected employment to climb by 391,000 jobs. It marks the 12th straight month of job gains, but isn't from a February gain of 714,000. At the same time, the US unemployment rate was unchanged at 3.6% in April. As the USD CAD, the quote recovered and traded at the high of 1.2860 on Thursday. The pay is expected to move in the range between 1.27 and 1.29 today. The trading instrument keeps hovering around the high. Due to a sharp rise in the oil prices, the price cannot approach the 1.30 barrier. The pay is unlikely to break through the mark for as long as the fears of an embargo on Russian oil imports to the European Union wane on the commodity market. Speaking of fresh statistics, Canada's employment data came in disappointing today. The Canadian economy added 15,300 jobs in April of 2022, following a 75,000 increase in March and widely missed market forecast of 55,000. The number of part-time jobs went up by 47,100, and on top of that, the involuntary part-time employment rate fell to a new all-time low of 15.7%, but was almost offset by a 31,600 increase in full-time jobs. The data is unlikely to affect the pair today. Yesterday alone, Bitcoin lost 8%, and today the quote reached the swing low of $35,500. The number one cryptocurrency kept incurring losses along with the other altcoins. Should the assets consolidate above $35,200, the downtrend will slow down. However, if it breaks through the barrier, the quote may hit towards the low of 32,000. The likelihood of a further fall in the market remains quite high today. Trading instruments are extremely volatile. If panic in the market continues, the week might end to be the mass sell-off and the new historic records. In any case, we will continue to closely monitor developments in the equity market so that you do not miss a thing. In this meantime, have a nice weekend and see you on Monday.